I have a hard cutoff of 5 o'clock today, so let's jump right into it. I am an associate member of T3 Trading Group, which is an SEC registered broker dealer, and member of FINRA SIPC. All trades placed by me are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial conditions. Here is the position disclosure. And I'm going to grab a chart and we're going to jump on into it. Oh man, that was crazy into the close, huh? That was just totally bonkers. Look at that volume. Look at that move. $10 billion sell imbalance hitting in the last 10 minutes there. The early imbalance was 2. It sized up to 10. Pat saying it's the biggest imbalance he's ever seen. I don't remember really seeing anything that big over myself either. Just massive, and the stocks just got wrecked. I think I saw Apple with a 4 million share sell imbalance. It then increased to, and was trading weak, was above 175, and then I think it bumped up to like doubled. It was like 8. And then they just wrecked that thing all the way back down, and then it went back down to 3, and then it tried to rally real quick. Oh man, just totally bonkers here. But those shenanigans are past us. You know, just end of quarter rebalancing kind of coming in there, albeit in a dramatic way. And I remember looking at data back here when the market was making new lows for the year that was showing that quarter end imbalances we're set to have a ton of buying. But then look at this rally that we had since then. So I don't know if that flipped it or what the situation was there, but huge sell imbalance coming into the market, into the close. But let's look at our technicals. So the market did exactly what we expected. I was surprised that we didn't sell off bigger yesterday. I'm sure you'll remember me remarking that. I really thought we needed to have a technical pullback, and then coming into today, it just didn't seem to me like we were going to get. It didn't seem to me like yesterday was this day, where it was one day of price correction and then we're back ripping. I really thought we needed more price or time correction, and honestly, the price action for most of the day today was pretty sloppy and choppy, and I would actually broadly consider this to be bullish, to be honest, that we were continuing to correct through time and not price. Those underlying buyers are still sitting in there and kind of holding this market up. And then, you know, that obviously changed here in this last 30 minutes. They started selling this market off when the early imbalances became visible, and then that increased, and then you guys know what happened at the end of the day. But what that leads to is a, you know, pretty wide-ranging kind of candle here, or wide-ranging compared to some of these more recent ones, I guess. Not wide-ranging compared to what we've seen on the year, but a pretty wide-ranging SPY candle here that is negative. Did not close quite on lows, I guess, unless we're already up. Yeah, we're up a little bit since we closed. But we corrected down to the ADMA on the daily chart. So this sell-off here, you know, market is down. Market's down 1.25%, and again, we've already bounced $1 since the close. This sell-off here, market selling off, you know, 1.5% or whatever today after yesterday's sell-off, really just brings us back to equilibrium, to the upper band of equilibrium, not even into the equilibrium range. So it just shows you the degree of the strength that we've had over the course of the last couple of weeks coming into this price action. And only now do I think things start to get a little bit interesting here. Only now are we really going to see if bulls are truly in this market. I mean, that's pretty much what it comes down to, right? I think that a lot of this rally we were able to identify was because of positioning, right? Participants were just too short, not long. Hedges got unwound. Shorts got squeezed. We had this huge rip higher. And now that we've really kind of had our first correction here, the question is, are real buyers going to actually step in at some point? From Andy here, late move lower is attributed to the JP Morgan SPX color. Went up at 11 a.m. and I'm hearing The unwind by the dealers was at the close. Okay, interesting. But yeah, anyway, I think that this is where we're going to start getting things to be a little bit interesting to see if buyers can actually come back into this market or not. And look, we could still correct down further. The market could go to 447, 450 for sure, even maybe as deep as 445, and still be kind of, not necessarily bearish, but just a technical percentage pullback of this huge up move that we've seen. But at some point, as we start to get into the area where we are right now, the space between 453 and it's a wide range because the up move was so big and the space between the 8 and 21 EMA has gotten so big. But at some point here between 453 and worst case scenario, probably 445, you need to see buyers come in and make a higher low. Because for the most part, we didn't even get any higher lows in this up move. I guess here we had one. This is not an uptrend that we've been in, though. We've just been in up. Up is not an uptrend. Up is just up. Up is momentum, really. I need to see if this market, which had been in a downtrend for this year, and then just had this kind of insane straight up rally here with the exception of literally one day of a pullback and one pivot low, actually does lend itself to a pattern of higher highs and higher lows. So that's it. We got the pullback that we were looking for. We hedged ourselves, or at least some of us did. I did 2 trading sessions ago into the close. I liquidated those hedges today. I am now out of them. It perfectly did what I wanted it to do. Even if the market pulls back further, I'm fine that I got out of them because I had a very specific game plan for coming in place and paying attention for time and price correction. We got that correction now primarily through price. And I'm out of those hedges, and I want to see if we can get a pivot somewhere and work our way back up. So we will see how all that plays out. Let's see if we have a different picture from our Qs. Same thing, Qs coming back to the 80 EMA for the first time here. We could also go lower for our Qs before creating a pivot. The 80 EMA is all the way down to 452. We touched just the 21 EMA is all the way down to 352. We touched just the 80 EMA here for the first time into the close. I don't think we even technically fully nicked it. So we could pull back a little bit further, but you can also say that we are no longer really extended to the upside after today's close. We kind of had the perfect price correction that we were looking for. And now the question is, do we get a pivot point to come in, let's say somewhere between today's low, what is today's low? Somewhere between today's low of like 361 and even as deep as under 355. So that's what we want to watch for at this point. I'm just reading out of the corner of my eye. Josh, I think it's important to note the selling pressure shouldn't be there tomorrow after the close we had today. I think we'll be able to play longs versus today's lows. Yeah, we'll see. Let's assess how we gap tomorrow and kind of figure it out at that point. So that's SPYs, that's Qs. Let's look at the Russell, though. Russell definitely a little bit concerning to me. Into the equilibrium area, so maybe I don't want to overread it. But I don't like that we lost that 207 for the Russell. Just like how I said yesterday at the close, that I didn't like that we negated the breakout candle. So Russell is still of some concern to me. I guess it's kind of okay so far, but if we can't lose these pivots down here that are around 202 half or so. Can't lose those pivots, or bulls definitely have lost control of the IWM. So we'll see. That's our indices. As far as today's trading goes, today's trading ideas, once again, we said that it's a tough market right now. We had a flat open in an extended market for the second day in a row here, kind of nothing that we wanted to come in and buy. We just wanted to be patient, let this market price and time correct further, keep those hedges on, and maybe focus on names that were in play. So, I had a few things on my radar today. The ones that I traded were just CLVS and Path. One was a really good trade. One was not a good trade. But, of course, that all depends on, risk management. I ended up taking a bunch of trades in that Path. But let's look at CLVS first. Close at lows. I'm no longer in the position. I got stopped out of kind of a remaining little core that I had that I was trying to hold on to. But I mentioned, like right at the end of the morning meeting, that I just bought some CLVS. So my price was, I think, around 230. My original stop loss was 210. That was coming off of the daily pivot here. That's at 210. And I just wanted to see if momentum could come in. This is not the type of stock I like to trade. I don't like trading stocks that are this cheap. The only time I ever look to trade a stock that's this cheap is if I literally think I can get a 100% move in a short period of time. If I think that that's on the table, then I can get involved. And is a 100% move in CLVS today from like $2 in a relatively short period of time, over a couple days, let's say, possible for this stock? It is possible. We know that's possible because this has been a meme name in the past. We've seen this type of run happen where it's been able to go from $5 to $11 in a short period of time. I got some drug trial news. Drug trial stuff is usually when we can see these stocks run. I normally don't like trading stocks that are this cheap, and I also normally hate trading biotechs. I don't like trading biotechs. It is not my area of expertise. I'm not a doctor. I didn't go to med school. I don't have the time or patience to research these companies that have drug trials to try to give myself an advantage. And as a matter of fact, it's the drug companies that always find themselves up 500% one morning or down 90% one morning. And as much as I would love to wake up one day and see a stock that I'm in up 500%, I'm not willing to risk it being down 90% and blowing up my entire account in the process. So I normally stay away from these. I guess with one this cheap, the worst thing that can happen is it can go to zero, so you know exactly how much you can lose. But because of the news, because of the meme situation, because there was that level of $2.10, because I had nothing else better to trade, was definitely part of it, because we were being really patient in the market. I decided to go after this one. It turned out to be a really good trade for me today. I did very well with it. I was buying that 230. I had size. Caught this great momentum move here to as high as 288. My best sale was $2.86. It pulled back. I bought back some of my stock into this area. Someone was asking me about it at that time, and I was like, I wouldn't take a new trade here if I wasn't already in it, but if you sold some at higher prices and you want to buy that stock back to try to create some cash flow, sure, we can go for it. So that's kind of what I did there, and it caught this little bit of a bid. I was able to trade it back and forth. And then I kind of bailed on a lot of this actually early. And I apologize, by the way. I had an insanely busy day today. I had like an insanely busy day today. And I wasn't able to hop on the radio midday like I've been trying to. And I wasn't even able to communicate in text as well as I wanted to today, just because I was so swamped. But I ended up, cheating a little bit on my rules, stopping myself out of some early, and then getting stopped out of the rest when it broke that opening low. So I was able to raise my real stop to this point. So turned out to be a good trade that made me some money. Path, on the other hand, I had a feeler, and I actually kept a little bit still. I had a feeler in this path that I kind of rode all the way down, which I generally don't recommend that people do, but I will do it sometimes. I took a couple of trades in this thing that failed for me. I took like one trade that was decent, which was really Pat's trade. Pat called it out when this low here came in at, I think it was this one. Maybe it was this one. Can't remember now. So one of the things to pay attention to, I took both of these, honestly. So I'm trying to remember which one Pat actually called out. One thing to pay attention to on these types of things, and it was the second one, right? Well, it really did that twice. Poked new lows here and gave a little bit of a snap, and then I guess the one that you called was here, where it poked new lows and gave a little bit of a snap. One thing that you guys have heard me say, I think, a few times recently, and I was talking about it with the market, is that GameStop intends to implement a stock split through dividend. What the heck? Is GameStop running on that? GameStop's catching a bit on that news. They might really run this thing off that news, to be totally honest. It's kind of wild. Anyway, the point that I was trying to get across, it's notable sometimes when stocks don't do what they should, and you got to ask yourself why. So what Pat referenced here, the trade that he called out, which I jumped in on with him, was when this low broke here at $21.90. The new low was only 5 cents lower. Really, oh man, now I gotta manage my position. really, this stock on that break should go much lower, because you got to think about all the stops that are placed underneath that last pivot that had kind of come in. All those stops are getting triggered. It should create kind of like a wall of selling to the downside, right? Where you see like a big flush down. So the fact that this thing only broke by 5 cents when there should have been a big flush, that's information. So Pat saw that, called out the buy. Hey, it only broke by 5 cents here. It's extended to the downside. I'm buying this thing on the way back up, I think through $22 versus that low. And that's a good trade. I like that trade. And it gave an okay snap back, but the problem was it was too slow, which Pat and I also noted. You know, fine, this inside 5 finally broke up, and then when it was working its way to this ADMA, I communicated, I was like, I think this ADMA on the 5 minutes is just going to act as a wall of selling the first time it gets here. So the fact that this thing couldn't price correct, honestly, faster and give us a bigger move is a problem. If this thing could have price corrected faster to the upside, then there was a chance of like a higher low situation coming in, applying more pressure on the ADMA where it breaks up. But the fact that this was like a slow grind to the upside into that ADMA, it just wasn't a big enough a move. And when this selling pressure comes in at that moving average, it's probably going to bring this stock back down to new lows and cause the trade to fail. Look, moving averages are not support and resistance. I say that all the time. But what they are is... moving averages are not support and resistance, but they can be self-fulfilling prophecies. You do have algorithms that might be designed to buy or sell on them. And it's particularly true in these stocks that are sometimes having really big gaps. That the first time that ADMA on the 5 minute catches up, whether that gap was to the upside or that gap was to the downside, the first time that thing actually catches up, it will a lot of times bring buying or selling pressure with it. And that's kind of exactly what happened. And at this point, once that new low broke in, I think he kind of had to throw in the towel on this thing for the day for the most part. I took like another little trade kind of down in here that actually paid me pretty well. But I also had some failed trades in it. So net at the end of the day, I finished negative in path. But nothing that I'm upset about, you know, totally comfortable with the risk. I think I traded it well. I just didn't have my trades work out, which is different than what we were talking about in yesterday's afternoon meeting when I was doing stupid things and, you know, throwing away money. So that was that. And that's really kind of the entirety of my day. You know, otherwise, was waiting for this market to price or time correct. We got that. Had the hedges on. Got out of my hedges because they fulfilled the move that I was looking for. Traded a couple of these names that were in play. And that's it. That's it. That's all I got. I had to take a look at what this GameStop is doing right here. Pulling back a little bit. AMC catching a bid in sympathy. Bed Bath & Beyond caught a little bit of a bid in sympathy as well. Crazy times, man. This market is just... this market is so crazy. It really is nuts. All right. That's all I've really got to talk about. Honestly, not too much, because the market did what we thought, and we wanted to be patient. And now we got the correction here, and now is when things get interesting. So I'm happy to answer any questions that you guys have. All right. So scrolling up into the VTF. From Hope here, bounce since close points is 50% price gain of the drop from 320. Oh, since the close. Gotcha. Okay, yeah, good information for anyone who's trading the close or trading after hours, Hope. So appreciate that information. When you have a chance, can I detail the whole hedge trade, why and how, the reason to close it out? Sure, sure. You know, went over it in the other meetings as well, but happy to do it. So, do I still have Pat's note around? Or did I close it out? Oh, I guess I can just click on it again, right? So, 2 days ago, at the close, into the close especially, but even at the open, the market was extremely extended to the upside. Okay, and there's a number of ways in which you can measure extension. The way that I do it, I think as everyone knows, the way I like to do it is I measure extension by where the market is trading, and this applies for any time frame, where the market is trading versus the space between the 8 and 21 EMA. Okay, it is a rule that over time, price will always come back to the 8 EMA whenever it gets away from it. And that can happen in a number of ways. A market can have a technical pullback to that equilibrium area, or a market can go sideways and have the equilibrium area catch up to it. That second way would be more bullish in this case. We also do know that an extended market can become more extended. Like you could say that the market was extended to the upside after this day, and then it was even more extended to the upside after the next day. That can happen. That's particularly true when there's momentum. But especially for the indices, that can only last to such a degree, especially on the upside too. A lot of times when we see large degrees of extension, it usually happens on the downside. And the reason for that is because fear is a stronger emotion than greed. But we utilize this concept on both sides. And because we understand market degrees of extension, things like that, as a team, we were able to come in and buy the bottom on January 24th pretty much perfectly, and come in and buy at the open on February 24th at this low also pretty much perfectly. This one was particularly easy. You just had to believe in the trade, and the move off of it was huge. So we measure degrees of extension, and I like to couple that with other pieces of information too, so that I can have a higher probability on my thought process. So 2 days ago when the market closed at highs, I know that the market's really extended, right? We put in a high of 462 that day. The ADMA is at 450. We're extended by $12 to the upside for the SPYs. It's a lot. Qs were even more, I think. Let's see, Qs here, like 372, ADMA at 358. So Qs here, which are a cheaper ETF, were extended to the upside by $14. That's really big. On top of that, I had Diego, who's part of the team here and loves his DeMark indicators, letting us know that there was a DeMark indicator sell setup coming in. I think it was a 9 sell setup. And again, I think everyone knows that I don't really use a lot of indicators on my own trading, but I pay attention to the information that other people provide. And even though I don't specifically use DeMarks or Bollinger Bands or Ichimoto clouds or things like that, I'm going to pay attention when the information is provided by others. So Diego telling me that the SPYs, the Qs, Microsoft, Apple, I think something else, were all giving DeMark 9 sells at that area is an extra layer of probability on the information that I already know based on this extension that we should be having some sort of price or time correction. Then on top of that, to add even more detail, I got Pat's note. And I just can pull up Pat's note from today because it shows the information from a couple days ago. But you can see here on the short-term sentiment indicator that the market was in this red zone, which this red zone, again, it's just basically telling you the exact same information, but it's doing it from a sentiment perspective. It doesn't mean that the market can't go higher if there's momentum. It absolutely does. To me, this usually means that I don't want to buy, and maybe I want to hedge, because the market could use some sort of correction through time or price, which would bring this back down. So same thing. On top of that, we had the medium-term sentiment. This one, much more rarely than the short-term one, gets up to this red zone, and it was just ticking into it. So I've got all of these different pieces of information. The way that I look at charts, but also I got Diego providing me information, I got Pat providing me information. All of this information is pointing to the same thing up here, which is that we are really extended to the upside, and we could use a time or price correction. And then the question really is going to be, what is that going to look like, and how deep is it going to be? I can't tell you 2 days ago if we're going to go sideways here and the ADMA is going to catch up, or if we're going to price correct back down to the ADMA. I could tell you in terms of probability, I felt that the highest probability situation was a price correction like what we got. The second highest probability, which would have been extremely bullish, would be sideways price action, and the lowest probability was upside continuation at this point. I think we were beyond the maximum pain point for shorts. This last leg of this rally was really like the one that I think blew people's minds and really probably hurt some people who were trying to be short focused on this market, and it's reached that point where it's getting too tough. And on top of all of that, we're at resistance. The space between 458 and 460 is resistance. So I can tell you with a very high probability that we need to go sideways or go down as of the close 2 days ago. The market made it hard like it always does. We would have loved a strong close plus a gap up yesterday. We would have loved a strong close 2 days ago plus a gap up yesterday. That would have been like the most layup shorting opportunity you could think of to do that. Not what happened, because the market doesn't make it easy. The market actually made it very hard by closing at highs and then gapping down the next day. We discussed that in several meetings now. But all the same, and I'll tell you why it's hard. I was able to hedge myself because I had longs on. And I made this very specific game plan where I said, the market is extremely extended here. I just want a little insurance. I'm going to short UPRO, I'm going to short TQQQ, I'm going to short these leveraged ETFs, and they're going to act as an insurance policy for me to help damper my P&L a little bit from swings, as in if this market, kind of corrects back down, and it did exactly what I was looking for. I was able to do it that way because I didn't have a stop loss on my UPRO and TQQQ short. And again, I would not advocate that new traders ever do anything without a stop loss. But if you have a portfolio on like I do, you can kind of turn this into a little bit of a math equation as long as you're not greedy with it, as long as you are okay with the fact that you could lose money on your hedges. I was totally fine if the market wanted to go up on losing money on the hedges that I had on, because I still have longs on. It's not going to be a big deal. It really just would mean that I'm not going to make as much money on my longs, but that's what an insurance policy is, right? You buy flood insurance, and there's no flood. You're just spending money on flood insurance that would otherwise be in your pocket. But you buy flood insurance and Hurricane Sandy rolls through, you're gonna be glad you had that flood insurance, because it's gonna pay dividends. So that was the entirety of the thought process, and we got the price correction that I was looking for. We could pull back deeper into the space between the 8 and 21 EMA. We could pull back even to the 21 EMA, but it's not what I was game planned for. So those trades did exactly what I wanted them to do. And on top of the fact that I put those hedges on, I significantly lightened up on the positions that I had. I sold, I'm trying to figure out like what percentage of Apple I sold as an example. I probably sold 5/6 of the Apple position that I had on into the up move as an example. So, I'm lightening up on the way up, trimming and trailing type of situation, and then recognizing that degree of extension and recognizing that very high probability, because of all of these pieces of information I just described, that we should have a price or time correction, and now it's exactly what we had, so they serve their purposes and I'm out of them. So I hope that helps you. On the SPY chart, that market sell-off is entirely bullish. The candlestick pattern is called a bump and run. I've never heard that term before. That is where you are rejected along a key resistance point and then make a quick series of usually 3 lower high, lower low bull traps, and then ultimately will end with a waterfall sell-off. Okay, cool. Still learning new things. Scrolling through here on the VTF. Still scrolling through looking for questions. Cool. Next I'm seeing here is from Jackie. Today around 3, the Q broke above the VWAP. Okay, I don't have a VWAP on my charts. I've never had a VWAP on my charts. So I'm gonna have to take your, I assume you're talking about a 5-minute chart, 3 o'clock here. Okay, so I'm gonna have to take your word on it. So Q's broke above the VWAP and some intraday pivot points, but the SPY was still holding in a downtrend and looked like it was failing to hold above the VWAP. Yep, you can see here the SPYs did not have nearly as strong of a bounce there as the Qs did. And the market was like, this choppy sideways action in most of the day today was tough, because you had the IWM strong and the Qs weak, then you had the Qs strong and the IWM weak. They were like flipping back and forth a lot during the day today. But anyway, back to your question. So spies didn't do what the Qs did. When the Qs look like they may want to break out of the downtrend, but spy seems to be holding it, how can we determine which direction to take and maybe have conviction to try spy short there, even though at the time it seemed like spy could maybe catch up to the Qs and break above the VWAP at some pivot points too. Sure. So what you're describing here is one of the things I'm constantly paying attention to. The screen that I share during the trading session has SPYs, Qs, IWM on it, and like one chart of whatever I'm focused on in that moment. And one of the things I'm constantly trying to read and communicate to you guys is basically exactly the information that you're describing in your question here. I'm always trying to read where the relative strength is, what the indices are doing, and if all the indices are confirming one another. That's a really big thing. I remember we were looking at this negative Maribozu that came in at 10 a.m. today as an example. This was a very bearish candle, but we always want to pay attention to the opposite side to see if this candle can get negated, because that would be information. So, but what happens if one index negates it and the other two don't? Well, you don't have the same degree of confirmation. So I'm always looking at all three ECNs, at all three exchanges. And what I want is confirmation across them. If I've got the Qs that are telling me one thing and I've got the SPYs that are telling me another, it is notable that the Qs are relatively strong to the SPYs, that your Qs are your leader. That's really important information to have. But in this scenario, should the Qs breaking up cause the SPYs to then come up as well, but just a little bit late, and then the whole market is acting stronger? Or could it be that the Qs are breaking up, but the SPYs aren't giving you that confirmation, the SPYs are staying weak, and that's going to cause the Qs to fail? It's very hard to answer. You got to look at your other pieces of information. Where are we on the bigger time frame chart? Option flow, all the stuff that we like to pay attention to. You can look for other pieces of information to try to give you an idea. Should the Qs cause the SPYs to break up, or should the SPYs cause the Qs to fail? But you really don't know. So what I want to have is all the indices telling me the same thing. That's what we call, it's like a version of time frame continuity. And if all the indices are all telling me higher, I can feel confident about higher, but I probably would want to go to the Qs because they went first and they're most relatively strong. That's the way I look at it. I can't tell you, maybe I can with the other pieces of information, but just purely based on, in a vacuum, should Qs break SPYs higher or should SPYs break Qs lower? I can't. We can try to maybe get an idea based on other pieces of information, but otherwise you just don't know. And when I have that conflicting information like you're describing, to me that means I, for the most part, don't want to put the trade on. I have a lower probability of success when I don't have the same information coming from multiple sources, basically, or in this case, multiple exchanges. So hope that helps. Yes, Hope, I announced the hedge in the room when I was doing it. I announced it in the room. I announced when I was trading it. I announced when I would cover some. I announced when I would reshort some. That happened a bunch yesterday. Discussed it in afternoon meetings the last 2 days in a row as well. From Tommy. I got shaken out of the SPYs today in the last 2 hours of the day. I was looking at the 1 hour, and it was forming a hammer at strong support. Then a 15-minute shooting star formed. I literally closed my position just to watch it break down to my end of the day target. Also, this was a short. What advice can you give me for these types of trades where you're right on the direction but wrong on the trade? Yeah, that's always tough. The biggest thing I think is to make sure that you're using the right stop loss. You got to use the stop loss where the idea itself is wrong, and sometimes that calls for it being a little bit looser, and or not trailing it too tight. I know that the volatility in the end of the day was particularly wacky, and that's because of the end of the quarter rebalancing stuff. If you used the right stop and you got pushed out, there's nothing wrong with that. The only thing that you can assess for yourself is if you really have the stop in the right place. We all get pushed out of things that work occasionally. You know, we're working in a game of probabilities, so that means that in a big enough, you know, scenario, everything will happen that can happen. So, hope that helps. For Mr. Trees, do you ever look at the weekly chart for price to catch up to equilibrium from the 8 and 21 EMA, or is it just a daily thing? I look at the weekly too, for sure. The weekly is a very big time frame. It's really a very, very big time frame. So again, I pay attention to it. I look at it, but I don't really trade it in the same way that I trade the daily chart. It's just like an extra piece of information, kind of like everything else that I'm talking about there. Cool. Red 1893 is bullish on GameStop. Yeah, I don't know what to make of this news here after hours. This news after hours is wild. I'm happy for the apes though. Happy for the apes. Bring it on. Okay, cool, guys. Guys and gals. It sounds like I got through the questions. I didn't have too much to talk about today. You know, I think the market was kind of did the obvious, and it did exactly what we wanted to do. And patience the last 2 trading sessions was really called for. Patience paid. I like to say that. That's a new one I just made. And patience paid today, I think, from a big picture perspective. We got our technical pullback. It was beneficial to be hedged over the course of the last couple of days. And now that we're no longer as technically extended, you know, let's see what happens. So I'm going to call the meeting here. Have a great night, everybody. And I will see you all tomorrow.